Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is August the 22nd, 2023. It is now 3:21 p.m. Central Time. We've got about 40 minutes left in the trading day for both bonds and mortgage-backed securities. Now, again, what is the question that I get every single day? When are home loan interest rates going to come down? And again, you know that a year ago in January, I would have said, oh, that's easy. It's going to come down here in the summertime. In the second quarter, third quarter, we're going to have our home loan interest rates come down because looking at the historical data, we have every reason to believe that inflation is going to show itself coming down through the first half of the year. Things will start to normalize. The Fed's going to see that. They're going to stop increasing the federal funds rate, maybe even bring it down by the end of the year. And we're going to take a big breath and keep moving on. Well, that has not been the case. The Fed has not been happy with the way that the federal fund or the inflation rate has been coming down. According to the core personal consumption expenditures reading, they want to see the year over year reading at 2.0%. Right now, it's up in the fives. And they're saying that they're not going to take their foot off the gas until they get there. So they're going to use every tool that they can to get us to 2%. And they're talking about having a smooth landing, but they're going to have to take their foot off the gas and start lightening up as we approach that 2% number. And that is still yet to be seen. So for now, the other thing they're looking at is they're saying that employment is too hot. We're seeing too many job hirings, not enough layoffs. The overall economy when it comes to employment is too strong. I disagree with that. I think that a majority of the numbers that they're talking about are part-time jobs, which number one might mean that somebody isn't making enough money in the one job. Now they got to go to a second job, or number two, things have just changed in our world. People do like to have part-time jobs. They like to have side gigs. They like to have side hustles, all those kind of things. So it's just different. Okay, it's not like you got 200,000 jobs that came in on the Bureau of Labor Statistics reading, and they all, you got 200,000 people that got jobs at IBM and General Motors in the county. Like that's not what you have anymore. You have people that are saying, yeah, 200,000 jobs came in, but 150,000 of them were working for, Uber and Lyft and, delivering for Amazon. I mean, it's just a different economy. There's nothing wrong with that, but it does not provide the same type of stability to the economy that it used to back when people were getting full-time, even salary jobs. I mean, shoot, remember the word pension? There used to be a word called pension. If you don't know what that is, look it up. But there used to be pensions that would come with jobs as well. If you had a pension, you're not going anywhere, right? You're staying there your 30 years. Okay, so things have just changed. Find me a job that gives you a pension these days. So anyhow, that's what the Fed is looking for. Now, the next time we're going to hear from the Fed is actually this Friday. It's not going to be a Fed announcement to the federal funds rate, but it is going to be a discussion and some comments from Jerome Powell and probably some of the other members of the Federal Reserve Board because they're all meeting this week in Jackson Hole, Wyoming. It's called the Jackson Hole Symposium. It's where they all get together. They spend some time. It's kind of like a retreat, but the whole time they work and they talk about their overall feelings and what they're finding as far as statistics and charts and everything else according to our economy. And then it also, of course, influences what they're going to do in the future when it comes to the federal funds rate. All right. So that is a big, big key because that really does move interest rates on some other products that compete with mortgage-backed securities. All right. If you don't know what I'm talking about with any of this, go back and watch some more of the videos that I put out here on all of these different topics. So what we want to hear from the Federal Reserve here on Friday is something that is more sympathetic to the fact that inflation is coming down. However, based on what we've been hearing so far, it's still this kind of rhetoric that we are going to be aggressive until we get the core reading of the personal consumption expenditures to 2%. Okay. Now we want to get to 2%, but they also mentioned the thing called a smooth landing or a soft landing to the economy. Inflation went up, inflation comes down, and you have a soft landing and you cruise into a 2% inflation reading according to the core personal consumption expenditures. Well, we'd like to see that, but again, if you want to go to the river, you want to go to the lake, and you want to have a fun day at the lake, and you want to get there as soon as possible, and you point your car towards the lake and you hit the gas, and you go as fast as your car will possibly go, and you want to get there as soon as possible. The only thing that matters is that you get there as soon as possible. Then you don't take your foot off the gas until you're in the water. I mean, that's how you get there as soon as possible, right? I mean, you don't use an off ramp or go to the parking lot or any of that stuff. You don't walk to the beach with your, towel. Like you just hit the gas and you drive your car right into the water. And that's the concern. So we're hoping that they are wise enough to begin to let off the gas, pull back on some of the tools that they've been using as we approach 2%, which I really think they should start doing that now, but we will see. Now, if they come out on Friday and say, you know what, this just isn't working, we need to go even harder. We need to raise the federal funds rate another 0.5%, 0.75%, 1%. We got to get this under control, even though we've got readings according to, on some of the readings, the charts that we watch and some of the reports that we watch, that inflation is down 5% from its peak, but they're still acting like it's not coming down at all. That'll be a concern. So it's going to be very important to hear from the Federal Reserve here on Friday, hopefully talking about that we do see inflation subsiding, that we do see things working, we do see the effects of our work with the federal funds rate. That's what we want to hear. We don't want to hear it's not coming down fast enough. We need to intensify our speed. So we're heading to the river, we're going 100 miles an hour. It's getting close, but we need to go 120 miles an hour. That's not what we want to hear. So where are we right now on our charts with this information? Currently, we're to zero for the day. Okay, so we are completely flat on the mortgage-backed security. We are down 1 basis point on the 10-year Treasury. Now, do technical indicators matter? Okay, so do the technicals matter? Okay, and that is what we talk about when we're talking about charts. All the stuff you're looking at right now is called technical analysis. Okay, so Fibonacci levels, moving averages, candlestick charting, that is technical indicators. All right. So we talked about yesterday that we did not want to break above this ceiling of resistance, and this is for the 10-year Treasury. We did not want to break above the ceiling of resistance at 4.335 because there's almost a no man's land when you get above that number. Well, what do you know? We poked our head above it and came right back down. Currently, 3.33 versus what you don't want to go above 4.335. You talk about an actual, this is almost like a physical ceiling above us right now. And man, oh man, we hope that it holds. So let's take a look here at the mortgage-backed security in the same situation. What do you know? Here we are sitting on the floor of support that we've been sitting on yesterday and today. Again, in both days, we tried to run away from it and got pushed back up here by the overall investors. And right now we're sitting at zero. We're at 97.34. And what is the number that we don't want to go below? 96.891. All right, so you can see here in both cases that we have a ceiling of resistance on the 10-year Treasury and a floor of support on the mortgage-backed security, and you see the reality and the validity of these technical indicators that we like to take a look at. So what does that mean for home loan interest rates? Let's go over here. All right, let's run the Brent Bruce Daily, our very well-qualified 30-year fixed conventional home loan with a 800 FICO score and 25% down, because we like to see what does it look like? What are the interest rates really at today? So here is the parameters for the rates that we're running right now. So I'm showing you this for compliance purposes. And again, the banks that you're going to be looking at here are not banks that you can go get a home loan from. They're banks that mortgage brokers can get home loans from and give you much lower interest rates than many of the other mortgage banks. All right. So right now, Flagstar is currently leading the charge at 7.625 with a little bit of credit here, $680. Not a big difference from yesterday. Okay. Well, what do you know? When you have a zero basis point change on the day for the mortgage-backed security, you're probably going to be pretty close to where you were the day before. Let's open this up and take a look and see what happens if we want to pay a point. 7.25, somewhere in that range, 7.25. Let's go over here and take a look at some other lenders. PRMG, haven't seen them up there in a long time. If they want to pay a point, 7.25. Let's look at 11 Mortgage. Where are they at? If we want to pay a point, 7.25. A little bit more of a cost on that one. But you can see that it's pretty consistent right now. And what's going on? What is it that everyone wants to see? They want to hear from the Fed after the Jackson Hole meetings. So you're probably going to see a pretty darn flat week here. Not a whole lot of movement for the week, unless sometimes there's whispers. So somebody at the New York Times talks to somebody who is with the Fed and finds out that, maybe they are going to increase the federal funds rate in the future. That's the expectation. Okay, that can happen. And all of a sudden you'll see movement before we get the announcement from Jerome Powell and the rest of the Federal Reserve members. But we think that we'll have the most information coming out on Friday. So we'll be paying close attention to that. I will make sure to get back with you again tomorrow. Make sure that you like, subscribe, share, hit the notification bell at the bottom. And I appreciate you watching. Have a good day.